Powell made a huge mistake when he decided to drop rates even though we have inflation. But thank God the bond market stepped in and said, we're going to do the right thing. We're going to make sure yields go up. And that's what's going on. Hi, I'm Phil Grande at philsgang.com, a 30-year stock trading education group. Now, it's interesting because, see, Powell keeps saying how the corporations need a rate cut. If I just give them a rate cut, then we're going to have employment. They'll start hiring again. A rate cut is not their problem. They don't need a rate cut. They've had plenty of rate cuts. $6 trillion worth of stock buybacks. That's not their problem. The problem is confidence. They have no confidence in the economy, especially the government with our debt and deficits. Their problem is that the middle class, that is the consumer between the age of 35 years old and 48 with 2 kids earning combined income $75,000, $80,000, they are tapped out. That is the problem. The bond market knows that. They have, again, the worst delinquencies ever on record in autos, credit cards, mortgages. So bad since January of this year, for 6 months, never heard of, a 26% bankruptcy. 26%. Bankruptcies went up by 26%. Now, this is the consumer. Never mind the corporations. Corporations, their bankruptcies increased by 40%. So see, the corporations don't need a rate cut. What they need is a strong consumer. But our labor market is the problem. We don't have a strong labor market. So Powell, by going in and playing politics, cutting rates into inflation, you're going to see the yield, 10-year yield, going up. That means interest rates go up. See, remember, when you have the bond market tells you the truth. When the bond market, the yield is falling, is going down, that benefits the stock market. That benefits growth stocks. That benefits your tech stocks, anything with tech. But when you have the yields in the bond market going the other way, going up, you've got a real problem. Because that means interest rates are going up. That's not good. Now, let's take a look at something. We're talking about the middle class. Let me first play this cut for you. This is some dope on CNBC.
After a night's sleep, traders applauded the Federal Reserve's move to trim interest rates into a still steady economy, bidding the stock indexes to new records, even as bond yields moved a bit higher.
Now, did you hear that? Steady economy? Even though bond yields are up a little bit, not to worry. Listen to this dope. This is the interesting one.
Wealth has just absolutely exploded over just since 2019. The wealth of all of the Americans has gone up in just 5 years by $52 trillion.
62 trillion. Wealth has gone up. All Americans. What is he, nuts? Another law. Here, take a look at my wealth chart. Look at this. This shows you totally what's going on. The blue line is the 1%. Look at the wealth, how it's going straight up. And now, here's our consumer, right here. Look at their wealth plunging. It's almost 2 to 1. So, when you are a manufacturer or a retail store, you're not going to order inventory. You can put inventory on your shelves when you look at a chart like this that consumers are dying? No. So, but at least the bond market did the right thing. They said, we got to raise rates into inflation, because if we don't, we're going to be in another 2007, another crash. Now, the interesting thing is this. If you take a look at, I'm going to give you another chart, manufacturing. Look at this. manufacturing is plunging. It's plunging. Since February 2023, they lost 178,000 jobs. We have one of the worst manufacturing employment situations almost ever. It's awful, the jobs we're losing in manufacturing. That is just nuts. Now, let me show you something else. One thing that I always look at is trucks. Why? It's a great indicator. It's like the yields. It's a great indicator, the bond market rather. Trucks move everything in this country. If we have a good economy, you buy new trucks, buy new fleets. Corporations do that. Let's see how much they're buying. Take a look over here. Heavy truck sales. Now I'm going to show you what happened in 2001, 1998 to 2001. Remember the dot-com crash right here? See the dot-com crash? Well, what I'm showing you is not the dot-com crash. I'm showing you heavy truck sales. They dropped first, and then we had the dot-com crash. Here's the housing crash. Housing crash, right? And financial crash. Well, right here, this is the crash. All right? Okay, well, at the same time we had the crash, remember, heavy truck sales went down. So my point is, truck sales went right down before the dot-com crash, right before the truck sales went down right before the housing, financial crash, and here we are today, starting to do what? Go down. That's right. This is why the bond market is got in and said, we got to fix this. We got to make sure yields are going up. Now, that causes a problem because you have to think, okay, well, then what kind of stocks do I buy? Do I buy growth stocks? Do I buy value stocks? Because remember, if you're going by fundamentals, anytime that you have falling yields, which means falling interest rates, you buy growth stocks. Techs love falling yields. They love falling rates. But if you have yields rising like we do now, today, like what happened in 2007, that's a problem because you should be buying value stocks. Pepsi, Coca-Cola, Johnson & Johnson, the typical defensive stock, the typical discretionary stock, Ford, GE, GM. So now someone's going to ask, well, wait a minute, what am I to do now? Yesterday, I was so thrilled. The yields were going down. I jumped in and bought tech stocks. Now we got a problem. Yields are going up. Do I get out of my tech stocks and go to value stocks? Do I get out of Apple and go buy Coca-Cola or get out of Apple and go buy Nike or Walmart? That's the problem. See, Wall Street has always taught investors to follow the fundamentals. This is going to be very, very bad. Here at Phil's Gang, what I've always taught for over 30 years is you follow the money. Then you're not going to be confused. Throw the fundamentals out because nobody's following the fundamentals. Fundamentals went out of the room when the dot-com stock buyback started. Remember, when we started doing stock buybacks in 2009, it was only supposed to happen for about 90 days. But they said, well, we're going to get rid of it in 2012. Well, what happened in 2012, they stopped with all these stock buybacks, or QE. Think about it this way here, QE. When we had the crash, Obama and Bernanke said, we got to get Wall Street back on its feet. So let's go in, and what we'll do is print all this money, very inflationary, and we'll take this money, we'll print it, I'll first drop the Fed rate. Remember, the Fed rate is controlled, okay, by the Federal Reserve. So they drop it down to zero. Now that is to help bring down the 10-year Treasury. How do they do that? Well, when they drop the rates down to zero, then they borrow all this money. The Fed borrows all this money. And they go and they give it to the 5 biggest banks they control, and the 5 biggest banks go in and buy treasuries, 10-year treasuries, so the yield will drop. So that means that you got good pricing, interest on mortgages and credit cards and automobiles. So that's what they did between 2009 and 2012. That's what was keeping the market up. QE, i.e. called stock buybacks. Now, the problem with the stock buyback, they were only supposed to be doing this in QE for 90 days. But it went from 2009 to 2012. Because why? Why? What's the problem? Well, the problem is if you take and you purchase a stock and your stock's going up nicely, right? It's at $20. Now all of a sudden it's at 40, it's at 80. But there's a problem. The sales aren't going up. So if you bought a stock, it was at $20 and the sales were $1 million. The next quarter, you buy, again, your stock goes from 20 to 40. Well, what sales? They went up too, right? No, they didn't. No. The third quarter, stock, let's say, goes from 20 to 40 now to 80. Well, the third quarter sales have to be up. No. So what they're doing is by purchasing stocks, the insiders buying stocks, you reduce the amount of shares. So it artificially pushes up your yields, pushes up your earnings, that pushes up your stock price without having to have sales. Now, the problem with that, this bubble gets bigger and bigger and bigger, and the valuations get insane. So the more the stock goes up, some of these stocks were at $20 right now are trading at $300. That's the damage stock buybacks do. So now what's happened is that we reached a point, all this inflation of printing money to do these stock buybacks, to do QE. When you print money to give to the Fed, so the Fed gives to their 5 banks to go buy treasuries, that printed money creates inflation. When that stopped in 2012, they wanted to tell us, oh, it stopped, but it didn't. Here's what they did. They said, let's keep increasing the money supply. People won't know the difference. Increase the money supply. Ask anybody on the street, what's the money supply? They don't know. So they kept increasing the money supply, and the money supply kept going through the roof. Let me show you. So when you have money supply going crazy, okay, if I get right here, go back to, you see it right here. If you go back to 2009, right here, okay, this is where they did stock buybacks, but at the same time, they're increasing money supply, right? So by 2012, we got to 2012 right here, they had to stop doing QE, or at least they told us they're going to stop doing QE. So what they said is, well, let's see, in 2009, we had money supply of about 7 billion, okay? So what we're going to do is let's push it up, and they did, and by the time that we hit 2012, okay, around 2012, it was around 10 trillion, not billion, 10 trillion. So they stopped QE, stopped stock buybacks, we thought, but they didn't. Look at the money supply. They kept pushing the money supply up to where we are today. Look up here, see? So we never really stopped. So we went from about 8 trillion to 22 trillion. Increased the money supply. And the money supply, they take the money, shove it into the banks. The banks are told, the 5 biggest banks, lend it to the CEOs of the corporations. Don't lend it to the folks. Lend it to the CEOs of corporations, 0 interest. They can keep doing stock buybacks. So now when you look at the stock buybacks, this is what, if you look at this, and then if you do an overlay of the stock market looks like this. When you do an overlay, it looks just like this. I'll do it for you. It looks just like this. It follows it right up. Same thing. Because it's that money supply that's causing us to do a few things. One, you increase the money supply. That means now there's enough money to increase the stock buybacks, and there's enough money to give credit to people who want to borrow money to buy stocks. So as long as you continue to have increased money supply, as I'm showing you, that will fund the stock buybacks, which they understand. And then the other thing, as long as you have enough money, then you can fund, they're called margin accounts. You can fund folks who are buying stocks. And the margin accounts are $1 trillion. People are borrowing $1 trillion to buy the same 4 stocks. Which ones are they? Apple, and they have a total of stock buybacks over the last 10 years of $735 billion. Take Meta, another $207 billion in the last 10 years. That's why the stocks are going up. And then you have Nvidia, $89 billion, and Google, $317 billion. See, that's how stocks are going up, because it's all of this money, but that's all created inflation. So by the time we hit 2020, COVID, inflation was already near 5-6%. But then what did they do? They printed more money to give everybody a bunch of money and tell them to stay home, put your mask on, don't go to work. And people in restaurants that used to pay someone $10 to wash dishes, they had to pay them $25 to get somebody to come in and work. Nobody would work. Everybody was home. So that has led us to where we are today. We are in such a mess that the corporations, it's not about interest rates, not at all. Okay? It's about they have no confidence, because we have corporate debt, we have the national debt, and here's the problem why they don't have confidence too. The national debt. We always could count on Japan, China, and the UK. Those are our 3 big banks. Every time we have to pay off our national debt, have to pay off our deficits, we go to them and borrow money. So they give us the money, we give them the IOU, right, which is a bond. Guess what? That debt we have right now, $38 trillion and the $2 trillion in deficits, that has to be paid off in the next 4 years. Well, that should be no problem. They'll just buy the debt from us. No, they're not. Last 5 weeks, we've offered those 3 countries treasuries at a low rate to borrow $200 billion. They walked away. Where are they going? They're going to gold. That's why gold's going through the roof. Look at our. We started to buy the miners, GDX, up 92% the miners. That's where the money's going right now. So the bottom line is the problem's going to be, if the yields keep going up, then what stocks do you buy? Wall Street, unfortunately, is going to take your money now, okay? And they're going to start taking you, and they're going to put the money into value stocks. They're going to take you out of tech stocks, put into value, because they have to follow fundamentals, because that's all they teach is fundamentals. What we teach every day is follow the money. Matter of fact, we designed our own chart that shows you if the money's going into your stock or not. We developed that chart 25 years ago because it's about pricing, it's about money. So now they got a real problem. So if you're in a 401k, they're going to switch you from tech stocks to Coca-Cola, from Apple to Pepsi. Now, the big problem comes as the yields keep going up. That means more inflation, higher interest rates, and you're going to end up exactly what happened in 2007, a crash. Oh, I'm not supposed to say that. Do you notice now nobody talks crash anymore? You're not allowed to say that. You're supposed to say a refinancing, a price refinancing. That's what they're saying, a bunch of dopes for repricing. So how do you play a market like this? You got to follow the money. And we've been teaching this now for, oh my God, for over 30 years. How do you follow the money? We designed our own charts to follow the money. But the other problem for the folks is they don't know how to sell short. 90% of the retail investor loses money over the last 50 years. Don't believe me? Check it out. 90% of retail investors lost money over the 50 years. Why? Because they have to trade to perfection. When all you can do is buy stocks, it's like saying you're going to buy a car with forward but no reverse. What are you, nuts? But that's what you're doing with stocks. If you don't have the ability, when the market starts correcting, remember the market corrected from February down to April? Remember that big 32% pullback? People lost all that money because they didn't know how to short. So even though we got it came back up, they really didn't make any money because all they're doing is just getting even. But if you know how to short, see the difference? And if you know how to short, you don't have to buy to perfection, which means you got to be so good at buying stocks when all you can do is go long. It's like buying a car with no reverse. You have to be such a good driver, you can get into a parking space without going backwards. I like to see that, okay? So that's where we stand right now. So we got terrible manufacturing going on. He made a terrible decision. Rates are going up, yields are going up, interest rates are going up. The labor market's not going to get better. And hopefully, when we do crash, or I should say, if we have a price retracement, that maybe they can stop it and continue this rally by doing more stock buybacks. And I would not be surprised at all if they came in and doubled the stock buybacks. Again, here, look, see the money supply? They'll just push the money supply up again, just keep pushing it up. So they'll increase the money supply again, right? And they'll just keep pushing it up higher, so they'll just keep pushing it up, push it up, push it up, push it up, right, the money supply. So that money would be used for what? Stock buybacks, and to lend money to retail investors who buy on credit. And that's what's pushing it. So again, as long as you have stock buybacks, increased money supply, the market can keep going up even though the yields are going the wrong way. Meaning anytime you have your yields going up, it puts downward pressure on your stock. So that's what we got to wait and see. So you got to follow the money to find that out. And you can follow us. So check it out. Just go to philsgetting.com. Okay, again, a stock trading education group for 30 years. We'll help you out. I hope you enjoyed this. Hope it makes some sense to you, because that's what's going on. Remember, always follow the bond market. It'll never lie to you. Tells you the truth. Tells you if your stock is going to go up or down. Tells you if there's going to be a crash or no crash. We'll show you how to read that bond market, okay? See you on the charts. Free for 10 days.